So chapter 8, here we go, right? It says use the following information with the table to answer the next two questions. So once again, the most important thing that you need to know here is right here, it says right here, the tracking and costing method are perpetual and it's LIFO, okay? So that means last in, first out. So in this case, right, let's go ahead and go through this scenario, right? If on June 1st, we decide to purchase 100 toys costing $1 each with the freight costing $25. So same exact scenarios, only difference is the tracking method is going to be different. So in this case, let's go ahead and utilize and plug in our table. So June 1st, okay? We didn't sell anything yet, but we did purchase 100 toys at $1 each with a freight of $25. So in this case, what is my purchase price?
100.
100, okay, plus 25.
125.
Good. And because we're using LIFO, we need to figure out our cost per item, which is $1.25. Okay? All right, good. So let's see what else happened next. June 10 rolls around and you end up purchasing 200 toys costing $1.25 with a freight of $50. So once again, we are purchasing, so no selling. So we bought 200 units at $1.25 with a freight of $50. So in this case, purchase price
$250.
$250.
300.
Which will give you,
Well, that would be 150.
it'll give you $1.50. Good. So in this case, right, now, because we're using LIFO, right, these two batches are separate because we purchased our first purchase, which is the first 100, and then we purchased the second one for the batch of 200, which is right there, okay? So and now, what happens when we sell on June 12th? We sold 200 toys at $5 each with no sales tax. What happens if we sold something?
We need to report a sale.
We need to record the sale, but what comes after the sale?
We need to update the inventory.
Yes, we need to figure out how much it cost me for selling those 200 units, right? So in this case, June 12th, right? Because after we recorded the sales, we need to record how much it costs to sell. So in this case, if I sold a total of 200 toys, right? Using the rules of LIFO, how much is it going to cost me to sell to the 200 units?
We are selling the most recent purchase first.
Which is the one that we made on June 10 for the 200 units. So in this case, perfect. We're going to sell out our 200 units from that batch, which is currently costing me at $1.50 each, right?
Yeah.
So what's my total cost of goods sold here?
$300.
$300, right? Which is going to eliminate this entire 200 batch right here. Okay? We'll just put it in there. So then that means this batch of inventory is gone. Right? If you wanna strike through it, highlight it, or whatever it is that you want to do to keep track that you don't no longer have it. Right? Obviously, I'm giving you a real inventory table. So this one is just so then we can show you what happens, right? A simplified table, we'll say. Okay, so strike through. Okay, so I no longer have that batch of inventory anymore. Right? I only have that 100 batch remaining. Okay? So then on June 15, we end up purchasing 300 toys costing $1.50 with a freight of $75. So in this case, I made a purchase of inventory on June 15. So I didn't sell. I purchased 300 units at $1.50 with a freight of $75. So in this case, what was my purchase price here?
$450.
Good. Plus $75.
5 1/4.
Okay.
I don't know.
It's $1.75.
Yes, this one's going to be $1.75 per item. Okay. So then let's see what happened next. It is now June 20th, and you end up selling another additional 250 toys at $5 each. So we'll record the sale at $5 each, but then we need to figure out how much it costs me to sell those 250 units. So, June 20th, we sold 250 units. So in this case, I have 2 batches left because the middle batch that we just, or the second batch that we purchased is already gone. So in this case, I have my first batch at 100, and then I have my most recent batch that I purchased for 300 units. So which
Gonna go with
batch?
175 each.
Good. We're going to go for the most recent batch, which is going to cost me $1.75 per item. So in this case, how much is my total cost of goods sold?
437.50.
437.50. Good. So if I subtract that out, right, I should have 50 units remaining. With a remaining amount of, what is that? 87.50? I'm guessing.
Yes, it is.
Okay, good. All right. So that's how much I have left of that batch there. And then, of course, you're given here that on June 30th, you should have a total of 150 toys on hand. Is that true? Well, let's see. I have 100 from my previous, and I have the 50 remaining. So, yes, I do have 150 units at a grand total cost of whatever 125 plus 87.50 is.
$212.50.
$212.50. And how much was my total cost of goods sold? So this table's supposed to have total here. Total. Okay. So I sold a total of 450 units at a grand total of 737.50.
$737.50.
Good. So in this case, let's go ahead and answer the question. What is the total value of the ending inventory on hand, the 150 toys? Right?
$212.50.
B is the answer. And then last but not least, what is the total value of your cost of goods sold? Which we got $737.50. Okay. Good. All right, here's the next one right here. Using the following information for the table to answer the next 2 questions. So again, same exact scenario, but here's the difference. You're not able to do the same thing that you did from the other ones, right? Because they all had the same ending at the end of the day, right? This one, you can't do that because this one, the scenario changes every single time. So in this case, this one says that your tracking and costing method is going to be perpetual moving average. Okay? So this one is 100% different. Okay? So let's take a look at our scenario here. June 1st, we purchased 100 toys at $1 each with 25 cents. $25 freight. So in this case, the first scenario would be the same. So June 1st, right? We purchased 100 units at $1 each, which gave you $100, plus $25 freight gives you $125. So that means my current average cost per item is
$125.
$1.25. Okay? So then, let's see what's next. We made a purchase on June 10 for 200 toys costing $1.25 with a freight of $50. So again, June 10, we have 200 units at $1.25 with a freight of $50. So in this case, this gives me $250, and that gives me a total of $300. But in this case, what do I need to do next?
You add the two totals, divide it by the two totals of quantity.
So in this
By the
case, so
three.
100 plus 200 gives you 300 units. If you want to highlight this as your calculations, it doesn't really matter what you want to do here, so I'll just do it for the sake of this. Okay, so here's my 300, right? What's 300 plus my total cost here?
425.
425, and now
Cost,
I'll be
cost
able
per
to
item,
solve
1.41666666 with a 7 on the end.
good, right? 1.46666666, okay? All right, so let's see what happened next. If on June 12th you end up selling 200 toys, right, for $5 each, right, no sales tax. So now that you recorded your sales, we need to know how much it's going to cost me to sell those 200 units. So in this case, June 12th, and we sold 200 units. What is my current average cost per item right now?
1.41666667.
Okay, so what would be my total cost of goods sold? Go ahead.
283.33.
$283.33. So if you were to subtract that out, right, you'll be left with 100 units. Okay, minus 283.33. Oops. 283.33 will give you a remainder of,
Oh shoot, I messed that up.
We have $141,
$100 and
$41.67.
okay. So that's going to give you your average cost per item to be
1.4167.
good. Right? So again, if you want to highlight that too, go for it. Right? So that was what happened when we sold, right? We're taking and subtracting as we go. So that means the next one here on June 15, we end up purchasing our 300 units at $1.50 with the freight costing $75. So that's exactly what we got to do. It's the 15. We purchased 300 units at $1.50, which gave me $4.50. Plus 75 will give you 525. Okay. So what do we need to do here?
Add the total.
So we got
Divide
400.
by 400. Add the 141.67 to the 525 and divide it by 400.
So I believe you're going to get 66667. Is that correct?
Yeah.
Okay. And then that's going to give me an average cost of
1.666675.
how many sixes?
4 and a 7 a 5.
Thank you. All right. It's very important that you try to get as many numbers as you can. 6 is going to be the minimum to get the most accurate per penny. Okay. And I'm just going to, oh, not red. I want this to be highlighted yellow, okay, because that's a calculation. All right, that's your totals. So then, June 20th, you end up selling 250 units. So let's go ahead and plug that in. June 20th, you sold 250 units at $1.6667. Okay, in this case, I'm just going to leave it at 6. So what is my grand total cost of goods sold here?
$416.67.
Good. So if I subtract that 250 and minus that 41667, my grand total I should have left remaining is 150. okay, which is true, right? Because at the end of June 30th, you should have 150 units left, which is true. So 150. All right, what's my total cost now?
You got $250.
Okay, $250. If you want to take your average here, go for it.
And the average cost would be 1.66. It's the 66675 thing again. So
All right, good. So there we go. We have my ending balance here. What about my cost of goods sold? Let me see. We sold 450 units at a grand total of 7. So that's 0, 0, 7. 700, right?
Yes.
All right, awesome. Okay. So, answer the questions. What is the total cost of your ending inventory? We already solved for 150. It's going to give us a total of 250.
D.
Yep. And then number 34, what was the total cost of your cost of goods sold, which we were to solve was 700.
Yes, and
Yes. Okay. So that's how we just did all 6 methods. Well, actually, in this case, all 4 or 5 methods. Okay, because LIFO or FIFO, whichever one way we didn't do. I think we didn't do FIFO. It's the same thing, except you're just taking the money, or taking the first batch first, and then so on and so forth. So if you want to have practice that on your own, you may do so. There's a bunch of examples for that. Okay. So that was chapter 8. So now we're moving on to chapter 9. Okay. Use the following information to answer the next question. So if on January 1st you establish a petty cash fund for a total of $500, and by the end of January 31st you counted all your receipts. So in this case, you purchased a birthday cake for $19.99. You purchased a pizza for $23.78. You purchased office supplies for $6.02. And last but not least, you bought postage stamps for $10.75. So, question number 35 asks you, for what amount do you need to write a check for to replenish your petty cash fund?
oh, shoot.
It's $60.54.
$60.54, because in this case, what do you need to do? What's the rule of replenishing your petty cash fund?
You need to add up the receipt.
Yep, the
that you
total
paid out.
amount of receipts. Correct. So that means you should have a bunch of cash remaining left over. So all you have to do is just replace those receipts with cash. Okay? Trading them out for cash to replenish your petty cash fund. Excellent. Okay. Number 36. Okay, how do you establish a petty cash fund?
Debit petty cash and credit checking.
Good. You're going to need to debit a petty cash fund and credit the checking account. So letter A, right? You're not going to be debiting the petty cash fund and crediting all your expenses, right? Because that's not how it works. And you're not going to debit all expenses and credit petty cash, because that's not how you use the petty cash fund. Okay, so good. Number 37, how do you replenish the petty cash fund? Right? How do you replenish the petty cash fund?
Okay, I've got to be reading something wrong here because none of them sound right.
Okay. Elaborate. Why is A not right?
Okay. Because you deduct it from the petty cash fund, you take it out of checking.
Okay, good. But we're talking about replenishing the petty cash fund. Okay,
Right.
good. So good. A, you already debunked that one. So what about B? You're gonna write a check in the amount of the total receipts in the lockbox from the petty cash fund.
But you're still not writing the check from the petty cash fund.
You're not writing a. You're not right. This is the question is
Yeah,
asking to replenish, not to
I
add
know.
money.
But you're replenishing it the amount of the receipts, but the check doesn't come from the petty cash fund. And that's how I'm reading that. Am I reading it wrong?
Yes. Why would you write a check? Where does the check come from?
It comes from the checking account.
Correct.
But see, this says what I'm reading is write a check in the amount of the total receipts in the lockbox from the petty cash fund. The check comes from the petty cash fund, and it doesn't.
Okay, so in this case,
What I mean?
yes, I understand what you mean, but in this case, so the sentence that you're reading here are not two separate sentences, they are one. So in this case, the total receipts, okay, the receipts come from the lockbox from the petty cash fund. That's the second clause. That's one whole sentence.
Okay, but see, I wasn't making it two separate sentences. I was taking it as a clause in the middle. The receipts from the lockbox. The check comes from the petty cash fund. That's why it didn't
Right,
fit.
that's exactly, that's two separate clauses. I was saying
So
it's
I
one.
see what you're saying, but that grammatically told me a different direction. So it would be B then if that's the way that you read it.
Yes. Okay. You wouldn't write a new check, so obviously you wouldn't be writing a new check to the box. Okay, because then you're going to be over putting too much money into the petty cash fund, and you wouldn't count the petty cash fund and then write a check for the same amount. No. So in this case, letter B is correct. Okay. All right. So that's chapter 9. So now we're moving on to chapter 10. Okay. So question number 38. Right? Under which method does the IRS use to write off bad debt for tax purposes only? Okay, so there are two methods I showed you.
Well, for tax purposes only, don't they use the direct write-off method and it has to be done by the tax accountant?
That is correct. Yep, only the tax accountant is strictly allowed to use the direct write-off method. I did show it to you, but I did not. I told you that you're not supposed to do it, but I did show you how. Okay? You're literally going to write off the bad debt directly out from the accounts receivable, which is why it's called the direct write-off method. But in this case, we're not allowed to use it because it's only for tax accountants only. And your job here is you are not the tax accountant because you have to definitely go through a lot more schooling in order to be a tax accountant. And this is just being a general bookkeeper, okay? Someone who's just recording transactions. So in this case, yes, correct answer is letter C, the direct write-off method. Okay. So number 39, if a company estimates that $34,887 out of a $500,000 accounts receivable is to be uncollectible, okay, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be
Okay, it's balance sheet method. So you use bad debt expense, you debit for 39,887.
bad debt expense for 38,887.
9.
Oh, 39, sorry. 39,887. Okay.
And do credit allowance for doubtful accounts for the same amount.
Okay, so 39887. Yes, because in this case, we identified we're using the balance sheet method, right? And that means the allowance for doubtful accounts will influence your overall estimated amount. So in this case, if you have a debit balance, right, when your end goal is you're trying to get to 34,887 on the credit side, what you're going to do is you're going to add those two values together, so that does give you 39,887. Okay, good. All right. So that means answer is letter B. Awesome. Okay. Number 40. Okay. If a company estimates that 34,887 out of 500,000 total credit sales is to be uncollectible, and there currently is a credit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be.
Take it away, May. Or Ibra.
So it's a total credit. So the balance doesn't affect it. We just take the estimate amount of
Good.
3887.
Good. 34,887. Excellent. Okay, so therefore, that is correct because, like you just said, it's the income statement method. We don't see the accounts receivable, so therefore, the allowance for doubtful accounts will have no effect over it. But what if a company estimates that 34,887 of it 500,000 accounts receivable is to be uncollectible, and there's currently a credit balance? What do you do there?
You subtract it.
Yes, because right now we're already on the credit side in the allowance for doubtful accounts. I need to get to 34,887, right? So how much more do I need to do to count in order to get a grand total of 34,887 on the credit side? This case,
29,887.
29,887, because you're already on the credit side by $5,000. So 29,887. Okay, so 34 minus 5 is going to give you 29,887, which is letter C. Okay. All right. And then, of course, last but not least, if a company estimates that 34,887 of a 500,000 total credit sales, and this time there is a current debit balance in the allowance for doubtful accounts for $5,000, the adjustment entry will be.
You never allow the allowance for doubtful accounts if it's a the total credit sales, because it's income account statement.
Mm-hmm.
And so it would be the 34,887.
Good, right? Because in this case, again, allowance for doubtful accounts does not affect the income statement whatsoever. So in this case, no changes there, right? So let's take a look here. We're going to be using the following table to answer the following next question. So here is a copy of your bank statement, okay? Here is a copy of your check cash register, ledger, whatever you want to call it, and a copy of your check register right next here. So again, this is all your checks that you wrote, as well as your deposit slips right here, right, of all the deposits that you made, okay? And of course, you have your table right here to go ahead and complete your reconciliation. Okay, so which side do you want to start on, the bank or the cash side?
I'll start with cash ledger.
Okay, let's start with the cash ledger. Okay, so in this case, we need to find out what my ending balance is in my cash or checking ledger. So in this case, here is my cash ledger. What is my total value at the end of the last transaction?
$1,153.
And I'm going to highlight that so you know where to find that answer. So $11.53 is what is your ending balance in your checking account. Okay? What do you need to add on the cash side?
The credit we received
So
on bank statement. We have ACH of $125. And then we have interest $75. And then total of $200 credit. I mean yes.
okay, so
We need to add it 200.
good. So in this case, where did we find that? We found that in our bank statement under credits. So ACH for 125 and interest for 75, right? These are the numbers that we are looking at. So I guess I can highlight these as well, so you know where these numbers came from. Okay. So again, because this ACH once again is when you charge people on an account and they pay via online or via with a credit card, right? And then the interest is going to be whatever extra money you charge on top of that. So in this case, that's the money that the bank has collected for us. Okay. What else, okay, do I need to count for on my cash side?
The fees the bank took out of our account.
Okay, so in this case, how many fees was there?
There is 2 fees, service fee and NSF charge.
Okay, good. So I got charged for services and I got charged for NSF. So let's take a look at my bank statement one more time. Usually it's going to be located at the very top. Okay, so there we go. I got charged for service charges for $100 and I got an NSF for $50. Okay.
So we
And
need
with
to
a $50 NSF, you get a new bank.
Yes. Okay, so service charges $100 plus $50. NSF will give you $150. So in this case, what should be my adjusted balance in my in my cash ledger?
So we add 50, the difference of the two, which is $50 to the 150, to the balance. So it's $1,203.
Okay? If you see it that way, great. If you don't, great. If you could just go straight down, right? Take your 1153, you add 200, and you subtract 150. You'll get the same exact answer if you did not see it that way either, right? So again, I like to just go straight all the way down. You'll get the same exact answer as if you took the difference between your adding and your subtracting right here, and then just add it to your ending balance is also the same thing too. Yeah. It's simple math, right? Adding and subtracting will get you the same answer no matter how you look at it. Right? So that's one side. That means we're not done yet. We got to make sure that the bank side matches as well. So what is my ending balance in my bank account? So here's my bank statement. What's my ending balance?
It's $1,088.
So we got $1,088 as my ending balance. Okay. So 1,088 is my ending balance. Okay. What do I need to add to my bank account?
Deposits in transit.
Deposits in transit. So here, let's take a look at my deposits records. So, or my receipts and deposits, right? So how many deposits have I recorded?
5.
You recorded 5 deposits on your end, right? So let's double confirm how many deposits cleared in my bank account.
4.
4. So in this case, which one am I missing? I got 360, 297, 284, and 126. Okay, so let's see. 360 was my first one. 297 is my second one. 284 and 126. So which one am I missing?
483.
$483 has not cleared yet. So in this case, because we decided to deposit it on the end of the month, right? It might be a weekend, so it's not going to clear until later. So $483 is what I am missing. So to my deposit on August 30th for $438. Was it 438? 483. Oh, 483. $483. So therefore, $483. Okay. What do I need to subtract from my bank?
Outstanding checks.
Outstanding checks. So let's see, how many checks have I written out so far? How many have I written out so far?
8.
We written out a total of 8. So let's see how many cleared in my bank account.
We've got 6.
We got 6. Which one am I missing?
306 and 307.
We're missing check number 306 and 307. So let's confirm my check ledger. Check number 306 and 307 is right here. Okay. So 306 I wrote for $314. And then check number 307 was for $54. Okay. So those are things I need to subtract. Okay, so check number 306 and check number 307. Check number 306 was for $314, while my check for 307 was $54. So that's a grand total of $368. Okay. So, what is my adjusted balance in my bank account? If I started out with 1088,
103.
1203. So in this case, does this match? Yes, it does. Okay, so in this case, my answer is 1203. Okay. All right. So number 44, okay? You bought a bank bond worth $200,000 with an annual simple interest rate of 7.75%. And let's see, and it can be redeemable at any time. How much will the bank bond be worth in 10 years?
It'll be worth 350. I missed a zero somewhere in there. $355,000.
So in this case, how did you solve for future value?
You take the 200,000 times the interest rate of 0.0775
Okay.
times 10 years.
That is, what are you solving for when you do that?
Your interest that you'll be earning.
So good. So in this case, you got a total interest of $155,000, right? So what is your future value going to consist?
The 355,000.
Right. It's going to be your principal plus your interest. It's going to give you your future value. So what is this question asking you? Is it asking you for future value or how much interest you're collecting?
How much will it be worth of future value?
Correct. So in this case, that's what you have to look out for. What am I asking you? I'm asking you to tell me how much the future value will be worth in 10 years, not interest. But in order to get to future value, you need to solve for the interest first because that's how the formula works, right? You need to solve for the interest first for you to add it to the principal to get your future value. So in this case, your answer is 355,000 is your answer. Okay. So question number 45, okay? A credit card company is, okay, let you borrow $500,000 with a simple interest rate of 28.9%, okay? How much interest will be collected at the end of 2 years?
$289.
$289?
Yeah, because 500 times 28.9% times 2 equals 289.
Okay. So what's your future value, just in case you were asked that?
789.
789. Okay. So in this case, the question asks here, how much interest would you be collecting at the end of 2 years? You would be collecting the 289. Okay. That's a lot of interest, but again, that's what credit cards do, right? Well, instead of simple, they would be charging you twice as much, right? Because it's compounded every month. But in this case, that's a lot, right? At the end of 2 years, that's almost half
Yeah.
what you borrowed.
Well, it's more than half because half of what you borrowed would be 250, and if you're
Yes.
paying 289.
Yes, you're right. You're right. It is a little more than half. Yes, but in this case, in 2 years, and that's true. That's how credit card companies actually get you, is that they double up the money by charging you all this interest.
That's terrible.
Yes. All right. Last chapter right here is chapter 11. Okay. And this is the last section we're looking at here. So, question number 46. Okay. If fixed assets which fixed assets can never be depreciated? Land, right? They can only be depleted, right? Because land can hold value such as natural resources such as oil, diamonds, whatever you can find under the ground, right? You can't depreciate it, but you can deplete it. Okay. Parking lots, that's part of the property, right? So yes, it can be depreciated, right? Oftentimes parking lots, they get cracks in the ground, you need to re-cement it, so on and so forth. So it does have a life of its own. Same thing with street lights, right? Sometimes they break, okay? Sometimes they lean over. There's a lot of things, right? And buildings can definitely be depreciated. Okay? Number 47. Okay, if a fixed assets are depreciated, then intangible assets are amortized. Correct, right? So this is terminology, right? It's not going to be burned. It's not going to be depleted, and it's definitely not going to be wasted, right?
Hopefully.
Hopefully, yes. 48. Okay, if a machine was put into service on January 19, okay, when do you start depreciating it?
February 1st.
February 1st, because in this case, it fell after the 15th, which means it's less than 50% of the month. So you're just going to go ahead and treat it as if you're going to depreciate it starting February 1st. So that is correct. It's less than 50% of the month, so you're going to depreciate it the following one. Okay. Number 49, GAAP determines what two components for depreciation. So this one, I'm being very specific.
D.
B and C only, right? They determine the estimated useful life, and they also determine the salvage value. They don't determine partial years, okay?
No, you get to do that determination yourself.
Yeah, exactly, right? You have to do that for yourself. Okay? And question 50, okay, what are the 3 depreciation methods?
All of the above.
That is correct, right? I taught you every single one. Double declining, I taught you straight line, and I taught you units of production. And of course, there's beyond more than that, right? There's some of the years, there's all those. There's more than that. But what I taught you in this class is these are 3 valid depreciation methods that do exist, and I taught you all 3 of them. Okay. Number 51. Okay, under the double declining method. At the end, book value must be equal to,
Salvage.
yes, it must be equal to salvage value. Okay. All right, now we're going to be stepping into examples right here. So here, use this table below to answer the next two questions. Okay, so here you go. I'm only going to test you on two to maximum of 2 years, okay? So you can either look at the question first or you could just fill out the entire table. But in this case, right, this is what you're given. You're given that your asset is a computer, right? And the depreciation method that you're going to be looking at is going to be straight line, okay? Your asset cost is $2,500. Your salvage value is 0. Your estimated useful life is 5 years. And the date that you placed into service was January 5th, okay? So if I were to depreciate it based on years, right, what would my depreciation basis be?
Okay, the 25, whatever it is there, 2,500.
2,500, right? Because it's going to be your asset cost minus salvage value, which equals, well, there's 0 for salvage value. So you're going to be starting off with $2,500. Okay. What's my rate going to be?
It's 1/5.
1 over the estimated useful life of 5 years, which is going to give you
0.2.
20%. Excellent. So what is going to be my depreciation expense if I'm going to depreciate them at the end of the year, December 31st?
$500.
$500, right? Because in this case, you're going to take the basis of 2,500 and you're going to multiply by the rate of 0.2, which is going to give you 500, which you are going to be depreciating for the whole year because you placed into service as of January 5th, meaning you're going to depreciate for the whole entire year. So in this case, there you go, accumulated depreciation.
It's first year, so it's $500.
Good, right? It's going to be assumed because you don't have a previous years, so it's going to be $500. So what's my book value going to be?
It's 2,000.
Yes, you're going to take your asset cost of $2,500 minus the accumulated of $500. You're going to get a total book value of $2,000. Okay, let's depreciate for the second year. So what's my depreciation basis going to be?
It's same as first year, 2,500.
Good, right? And then your
Late stays same at 0.2.
good.
And then depreciation expense is also the same.
Yes, because it's straight line.
Accumulation is now 1,000.
Okay,
And the book value went down to 1,500.
good. All right. So let's answer the next two questions. So question number 52. What is the depreciation expense for year 1 and year 2?
Same $500.
Correct. Okay. And then question number 53 is going to ask you, what is the book value what's the book value for year 2?
It's $1,500.
Good. Okay. So again, that was one depreciation method that was straight line. So let's go ahead and do the next one. Use the table below to answer the next two questions. This time you have a printer, and the depreciation method that you're going to be using is units of production. The asset cost was $500. Salvage value is 0. The number of units that you can produce is 10,000 pages. Date that you placed into service was January 2nd. So in this case, right here are the units that you produce for year 1 and year 2. So what's my depreciation basis going to be?
It's 500.
Good, right? Asset cost minus salvage value is going to give you your $500, right? What's my per unit rate going to be?
So you divide the depreciation basis by the unit of production.
Good. Which one?
So it's 500 divided by 10,000.
Good, right? We're looking at total units that you could produce overall. So in this case, that should give you, is it 5 cents or 0.5 cents?
0.05.
0.05, okay? So if I were to produce a total of 2,500 pages as of year one, how much is my depreciation expense going to be for the first year?
125.
$125, right? So that's 2,500 times the 5 cents, and you're going to get $125. Okay? So what's my accumulated depreciation?
So first year is 125.
Good. So that will bring my book value to be
375.
375, right? You're going to take your asset cost of 500 minus the accumulated, which is 125, will give you 375. Okay? All right, let's go ahead and do for year two. Okay? What's my depreciation basis for year two?
The same as 500.
Good, right? Still going to be your asset cost minus salvage value, right? What is
The
your
rate doesn't change either.
Good. The per unit rate doesn't change either because you're still going to use the same depreciation basis, and you're still going to divide it by the total number of units that it could produce. So in this case, it's still 5 cents per unit. But this time, I decided to produce 2,000 pages. So in this case, what's my depreciation expense?
$100.
$100. So my accumulated depreciation is going to be previous plus current year's depreciation expense.
It's $225.
Good. So that will bring my book value down to
$275.
good, right? Your asset cost of $500 minus the accumulated depreciation of $225 should give you $275. Okay. So let's answer the two questions here. Number 54, what is the depreciation expense for year one?
B as boy, 125.
Good. Okay, so you have to be careful what I'm asking you, right? I'm asking you for the depreciation expense for year one. Okay. And then 55, what is the book value for year two?
It's C as charity for 275.
Good, right? Again, I'm being very specific. I'm asking you for the book value for year two. Okay. All right, last two questions. We're going to be practicing the last depreciation method here, which is double declining. Same thing here. You still got a computer. You're going to double decline it. It's got 5 years estimated useful life. The asset cost is $2,500 with no salvage value, and the date that you placed into service was January 5th. So let's go ahead and complete the depreciation table. So in this case, depreciation basis. What's my depreciation basis going to be for year one?
2,500.
2,500, because in this case, it's beginning of the year book value, which in this case, you just started your depreciation. So it's going to be whatever your asset cost is. What's my rate going to be?
0.20. 1 divided by 5.
1 divided by 5.
Times 2.
Yes, it's double the amount. So in this case, 40%. Okay. So in this case, depreciation expense is going to be basis times rate.
It'd be $1,000.
You're going to depreciate it for $1,000. Accumulated is going to be the same. So what's my book value going to be for the first year?
1,500.
1,500, right? Asset cost of 2,500 minus accumulated depreciation will give you $1,500 for book for year one. What's year two book for depreciation basis?
1,500, isn't it?
Correct, because it's going to be the beginning of the year's book value. In this case, the end of year one is going to mean it's going to become the beginning of year two. So that means you're going to carry the book value of 1,500 to the next year is going to be your depreciation basis. What's your rate going to be?
stays the same.
It stays the same, so it's still at 40%. So this time, basis times rate, how much is going to be my depreciation expense for year 2?
600.
$600, okay, which will give you
100.
$1,600 for your accumulated. So your book value is
Nine.
going to be $900. Good, right? 2,500 minus 16 is going to give you $900. So let's answer the following questions. So question 56, okay. What is the depreciation expense for year 1?
D.
D, $1,000. Good. Okay. And then 57, what is the book value for year 2?
D.
D, $900. Okay. So again, thought it was 54 questions, but it's 57 now. So in this case, there you go. We relearned everything that you need to know on this exam. So again, that's exactly what I'm going to do. I'm only going to test you for maximum of 2 years per depreciation basis. And so on and so forth, right? Very simple math. I'm only going to ask you for interest, just simple interest, because I can't assume that you have a calculator, a graphing calculator, or can use Excel. So I'm only testing you in simple interest, okay? And yep, so this study guide is pretty much a reflection of what you could possibly be tested on, except not the same scenarios, obviously, different numbers, okay? All right, any questions in regards to the study guide?